Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump says the U.S. economy faces, quote, a period of transition, deflecting concerns about the risks of an economic slowdown. In Canada, Mark Carney wins the race to become the next prime minister, succeeding Justin Trudeau and inheriting a tariff war with the United States ahead of an election by October. And Beijing begins imposing tariffs today on farm products from the United States. It's the latest escalation of a trade war between the world's two largest economies. Lizzy.
Well, checking in on these markets, Kriti, and we have those US recession fears swirling, weighing on US futures, down 0.5%. But look at the European story. Futures higher 0.8%. This gap opening up, the two-year Treasury yield steady at 3.97%, but euro dollar higher at 108 handle. The countdown to the opening trade starts right now.
Monday the 10th. Good morning, folks. Are we talking about a recession in the United States? Are we there yet? Is it going to be a Trump session? That seems to be the talk of the moment, and US markets have been responding to it. Last week, big down week. We're starting off the week in a similar vein this morning. Markets feel fretful, worried, nervous, Kriti, as we go into this week.
Nervous and have been for a couple of months, and then you got a confirmation of those fears with the payrolls report, of course, coming in at about 151,000. The survey was 160. Now, that's not a massive gap if you think about it, but the fact that you're starting to see some of these concerns show up in the data, and you're seeing that globally. It's not just a U.S. story. You're seeing it in the Beige Book. You're seeing it, of course, in the various U.S. pieces, but you're also seeing it in Europe and in China.
Yeah, and when you look at the data and compare it with the stock market story, of course, there's more of a link in the US than there is elsewhere in the world, because you have this disproportionate share of US consumers buying US stocks. So when Scott Bessent, the US Treasury Secretary, says that Wall Street's had its turn, it's now time for Main Street, actually the two are more linked than elsewhere.
The commentary's amazing, isn't it? You've got Bessent talking about a detox, the fact that the US economy has been reliant on this sugar high coming out of government spending for too long. He's going to remove that. Trump's basically saying, I'm not worried about the stock market, don't care about it. That's not my vibe at the moment. I want to talk about kind of the 100-year plan. I want to talk about the longer-term plan. Wall Street's got to be worried at this point, looking at the commentary coming out. It is a story that has been driven higher and higher and higher on the back of government spending. If that's removed, that is a big pillar being taken away from the US stock market.
So this was the Achilles heel of the Biden administration. They were looking at that 50-year kind of prospect and things like climate change, things like education, some of these policies, and then that's where they kind of lost the electorate. This is also coming where the timing couldn't be worse, in that so much of the economic resilience out of the United States that we've been talking about has been a question of savings, still savings coming from the COVID stimulus checks, some of the extra liquidity in the market. If you start to absorb all of that, they're not going to be able to absorb any sort of price hikes that are coming from corporations. And that's where the commentary I thought was interesting, is that if you talk about tariffs, corporations aren't absorbing any of it. They're passing it straight on to the consumer. They're not even willing to eliminate some of that.
So what happens next? Does this continue to drop? Does this market continue to go lower? I think that coming in on Monday morning, that feels like it is the narrative right now. And you've got a series of conflicts around the world. You mentioned China in the headlines, but let's talk a little bit about what's happening in Canada. Mark Carney is going to be the new Prime Minister. He's going to take over from Trudeau. I'm waiting for Lizzy to talk about unreliable boyfriends. I'm sure that commentary is going to come up at some point, formerly of the Bank of England and also of the Bank of Canada. The real question is, does Carney call an early election? The risk around this is that you leave a caretaker government in charge of a narrative that is really difficult to read with the United States. Or does he say, basically, the Liberals are actually coming back onto the front foot, and I need to take advantage of that, and I need to go now?
Yeah, because it shows that you really have to be in it to win it in politics. Just a few weeks ago, the commentary around Carney was, why would he even bother to do this when it could be a Liz Truss situation? And, the Conservatives are clearly going to win, commentators were saying. But given all of Trump's commentary on tariffs, the threats, but also the threats to make Canada the 51st state, that's actually worked in Carney's favour. And so it seems the polls suggest he actually has a chance at this point.
Yeah.
And you mentioned his time as the BOE governor. It does give me PTSD because I can say this now. Mark Carney speaks in clauses that get ever smaller. It's very difficult when you're a print reporter covering Mark Carney. But the other thing to remember about him as BOE governor is that this is a man who's dealt with crisis. He has been through Brexit. He's been through the financial crisis. And so he might not have political experience, but perhaps this is where he steps up in terms of Canadian politics.
Absolutely. And let's bring it back to the markets here, because when we talk about the digestion of some of those policies, you're already seeing it in lumber prices, for example. I'm having a bit of deja vu from when lumber prices soared off the inflationary story. You're also seeing it in oil prices, the idea that you are starting to have these kind of Canadian oil exports starting to be targeted potentially as well. And on top of that, not just a trade war with the United States, but a trade war potentially with China as well. Those agricultural products are now in question.
Yeah, so a trade war in two fronts, really. Notably as well, because we have to factor this into the inflation story, the latest Chinese data. So Chinese inflation dropping below zero for the first time in a year. And that confirming something that we already heard out of the NPC last week, with Beijing acknowledging that they needed to lower the inflation target because of these deflationary pressures. So really seeing this impact already in the markets in China, they just cannot shake off the bearish mood when it comes to oil.
They can't. So oil is lower. You've got a potential US recession. You've got China not recovering very quickly. Did you see what happened with property prices, property stocks today?
Yeah.
Down really hard once again. China's going to find it really hard to work its way out of this difficult economic story with just kind of technology as the driver. It needs those green shoots within the property sector to revitalise even further if it's going to deliver on this. So, yeah, metals are a factor. Commodities more broadly are a factor. Oil is lower. The signal coming out of that comes back to where we started, which is, are we heading for a recession? Even the Saudis are having to lower prices into Asia because they're worried about the growth prospects they're seeing at the moment.
Yeah, the OSP is certainly a great indicator of that. I think it's also crucial to mention here, though, is that even though we do see this weakness story in China, this deflationary story, how relevant is that signal for the rest of the world? Is this the moment where we start to see those fears around China exporting some of that deflation actually show up? So that's going to be something we monitor, of course, but it is certainly significant that we are now officially in that negative kind of data set when it comes to the China numbers. Let's talk about what's going on in Germany here, because we do have some German data that crossed the wire a couple of minutes ago. I want to walk you through some of these numbers because I'm seeing some positivity here, and that's not usually a word I use to describe Germany very often. Germany's January industrial production numbers falling 1.6% on a year-over-year basis. Now, the estimate was about 2.8% of a drop. So this is actually technically a positive number as well. The exports are, however, dropping on a monthly basis by about 2.5% as of January. The estimate was a gain of 0.5%. So a little bit of a mixed data set there as well. And I'm also seeing imports rising by about 1.2% on a month-over-month basis. The estimate also 0.5%. When you look at the euro, not much reaction there, but worth noting that a little bit of a mixed set, perhaps a hint of positivity.
I know, but you take that chart back another 2 or 3 days and you'll see the massive move that we've seen in the euro over the last few days. We'll get a technical take on that a little bit later on. Let's talk about who we've got on the show to walk us through all of this. Isabel Mateos Ilago, BNP's chief economist, is going to be joining us. Elsie Susi Watts, Global Digital Finance Executive Director. We're going to talk crypto there. William Hobbs, Barclays UK Wealth Management Head of Multi-Asset, going to be joining us. Do you buy this dip in US stocks? What are you doing with the bond market story? We'll get a take there. Plus, David Snedden, Snow Hill Consulting CEO and Chief Strategist, joining us to talk about what is happening within the markets from a technical point of view. Obviously, a lot of CTAs, etc., follow technicals, and it could be a good way of looking at the market right now. We'll get his take on what is happening there. A
perfect time to have that conversation, especially as we're looking down at a week full of data. Let me walk you through what's on the agenda for the entire week. On Monday, we do, of course, have the EU finance ministers meeting in Brussels. What kind of commentary do we have around the tariff story, but then also the deficit story, because that is still looming very much in the background as well, plus this kind of fiscal bazooka out of Germany. How reliable is the narrative we're hearing out of there? Then on Tuesday, we're going back to the data set in the States. U.S. job openings on Tuesday. Do we start to see those federal layoff numbers really show up there as well? Volkswagen earnings, we're going to continue that Germany story as well. And then on Wednesday, U.S. CPI. This is the big one. I'm looking at about I'm trying to find these numbers very quickly. I'm looking at a 4.28 on the 10-year. Do we see some major reaction in the back end of this week? Rheinmetall earnings as well, and the ECB is going to be on the tape as well. Thursday, U.S. PPI, and Friday, U.S. consumer sentiment, and then more German car earnings as well. BMW and Volkswagen this week. So what's more important here for Europe? Is it the data sets that we're getting out of the States, or is it the earnings story out of some of these German automakers?
I think the German automakers will be really critical. We'll just see exactly kind of how difficult the narrative is for them. Are they going to be, is German industry going to be a beneficiary of the industrialization that we're going to see via the rearmament program? I don't know. Does that feed across into other areas of the German economy? We will watch. The number that actually, the data set that wasn't on there that I'm going to be watching out for is the NFIB numbers, which also come out this week. Small business, backbone of the US economy. What are they seeing right now in terms of, A, the inflation narrative, the growth narrative? Take a look at what is happening with small caps in the United States. They've been hit really hard recently. There's some more data that I think we're going to see the market focusing on this week. The CPI is going to be critical, clearly, but I think the NFIB read is going to be really important.
Yeah, also just to link the two, the German car earnings and the US economy, of course the link is tariffs. And do you get those exceptions? Do you see business sentiment continuing to plummet when it comes to the German industry section as a whole? And tie it back to China as well. BMW's profitability hurt by the Chinese demand hit as well.
BYD's doing really well. Kind of basically making life very difficult for everybody else in China at the moment. So you've got a tough market there. You've got a tough market in Europe because of the economic backdrop. You've got a tough market in the United States because of the tariff uncertainty. It's a tough place to be right now for an auto company. Are we close to kind of all the bad news being in the price, I guess, is the question many stock investors will be looking at this week. Let's talk about what else we're watching. What else we're watching this morning. President Donald Trump says he is negotiating with 4 different possible buyers for TikTok's US business, and that a deal for the social video app could come, quote, soon. He didn't specify the contenders nor say which way he is leaning. TikTok faces an April deadline to strike a deal for its US operations or be banned from the country under a bipartisan law passed last year. Almost all of Germany's airports face disruption today because of a strike by the labour union Verdi. Ground personnel, baggage handlers and security staff have all been urged to walk out as they demand higher pay and more holiday. And back to the political story, Elon Musk's Starlink is rapidly becoming a key flashpoint between Europe and the United States. Over the weekend, the billionaire warned Ukraine that, quote, the entire front line would collapse if I turned it off. Poland, which pays for Ukraine's access to the communication network, then responded with its foreign minister saying that his country may seek alternatives if Musk's company proves to be unreliable. There then followed a tense exchange on X that drew in the Secretary of State, Marco Rubio. Starlink is also proving to be an issue in Italy, with the FT reporting that President Sergio Mattarella is concerned about Rome's €1.5 billion security contract with Starlink. This is getting fascinating and multi-front, and there's a sort of multiple fronts that are emerging.
Absolutely, and this, of course, comes, and you kind of hinted at there as well, when so many of these European allies are talking about sharing intelligence as well, or lack thereof, with the United States at the same time. Now you take away Starlink as well. There is only one major satellite intelligence provider, and I think we had an interview last week with Eutelsat, if I'm saying that right, talking about trying to fill that gap. But how quickly is that even possible?
Yeah, and how much does it cost to do that? That's a difficulty as well. And also, you know, if you talk about all these other companies that are trying to compete with Elon Musk, you've got Airbus, Leonardo, Thales. You have to open up the Pandora's box that is European politics. You know, Germany isn't going to want to be left out of that, so it becomes even more difficult. Yeah,
so the League in Italy is already concerned about the fact that basically you've got a British-French company, Eutelsat, that could replace it. It's worried about that. Why would you want to go with the French when you could go with the Americans? So even within Italy, there's deep concern about what is happening and which direction we're going to be going in. But how many articles did you read over the weekend about European defence, the footprint that America has, the concern that is growing within Europe about the ability of the United States to turn off key pieces of technology? This is getting more and more concerning from a European perspective. The problem is, though, from a time point of view, we don't have enough to be able to fill the gap.
It's also interesting, and we bring it right back to Italy here, which is that Giorgia Meloni was supposed to be viewed as an ally and a friend of not just Elon Musk, of Donald Trump, but the voice at one point of Europe, perhaps, to the United States. She's making some real divisions in terms of that stance. Things like giving Ukraine NATO security without perhaps giving it membership, still providing that aid as well, and still very much investing in that defense story. So I think this is interesting. That's a relationship, I think, to watch as well.
We've got very excited about this European defense story very quickly. The Euro's rallied. European defence stocks have gone to the moon very, very fast. Is there a moment now where we pause and reflect on the reality, the difficulty of actually achieving some of these ends, and how quickly, in particular, some of these ends can be achieved? Europe has a very big hill to climb, and the slope is very, very steep in order to get where it needs to go.
And which country's flag will be at the top of that mountain. But coming up, we have plenty coming up on the programme. Washington announcing a crypto reserve, but markets are trying to make sense of it, and we're going to dig into the details of that. Plus, Germany searching for an identity after the latest leadership elections. We're going to have more on Bloomberg's deep dive story on the politics there. But up next, back to where market concerns over the US growth loom large. We'll discuss that next. But if you have any questions of your own for our guests, please do send them to us on IB plus BB TV Go. This is Bloomberg.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
That was Friday. That was Jerome Powell speaking on behalf of the Fed, of course, talking about the fact that maybe the FOMC doesn't need to rush to adjust policy, despite some uncertainties that we are seeing. That feels like a long time ago, doesn't it? Since then, we've had President Trump talking about that recession risk. He was asked about it yesterday. He was maybe a little bit more equivocal when it came to the outlook for the US economy, short-term versus long-term. Let's talk about how this is all being reflected in market sentiment. Valerie's here to do just that.
On the market's mind is this growth risk narrative overblown when it comes to the move in the equity market and the move in the Treasury market? Yes, we had Trump again repeating that there might be a bumpy ride ahead for the U.S. economy. Scott Bessent, the Treasury Secretary, also mentioning there might be a detox period ahead on Friday. But we've heard these comments again repeated week after week. It's been 2 weeks running now. We've heard these dire forecasts. We've seen the S&P 500 drop 7% in that time frame, and a big rally into the Treasury market, and near 50 basis point move lower in Treasury yields. So is this move already priced in? That's the questions on markets' mind. Thankfully, on Friday, Jerome Powell himself didn't sound very downbeat on the U.S. economy. He said the U.S. economy is in a good place, and that helped the S&P 500 bounce from its 200-day moving average. We bounced pretty spectacularly from it, Guy, bouncing nearly 2% into the close on Friday. But again, these worries about the U.S. consumer, will we get any confirmation of it in the data this week? I don't really think so, Guy. The focus is going to be on the hard CPI data. Friday, we get the University of Michigan sentiment survey that might be the next kicker for these growth worries. But again, that is a soft consumer sentiment survey. We are yet to see any hard data when it comes to growth. A surprise on the downside.
Yeah, but the conversation is being had, isn't it? And the market can't quite figure out where we're going to go next and whether or not this administration is worried in the short term about that potential economic hiccup. Valerie, thank you very much indeed. Let's carry on the conversation. Isabel Mateos-Ilago, Chief Economist at BNP Paribas, joining us now. Good morning.
Good morning, guys.
Short term, do we need to worry about growth in America?
I think so. There's a lot of uncertainty, policy uncertainty right now, and that's created a little bit of an air pocket. Now, starting from a level of activity, of economic strength, so there's some room for a wobble, but This is something the administration should keep an eye on. And the fact that they're messaging instead that, oh, no, this is nothing to worry about, there may be some temporary disturbance, is a worry.
They're planning further down the road. They see a longer-term picture, maybe which is much more positive, but you've got to kind of wean the US economy off government spending. How could that work? What is the effect of a reduction in government spending into the economic data? How do you think about, when you build your models, how do you think about what that number looks like and the effect that it can have?
Well, the problem is that's not the only thing that's going on, right? You've got the cut or the potential cut or the start of cuts in government spending and federal workforce, but you also have the tariff uncertainty.
Yep.
So in theory, you can cut government spending and be okay if at the same time you deregulate, you do all sorts of things that incentivize the private sector to consume and invest more.
But we're not getting that yet.
But we're not getting that. In fact, we're getting the opposite. We're getting a negative confidence shock from tariffs, and consumers are worried about unemployment. Consumers are worried about inflation. Inflation expectations are through the roof at a 30-year high. And so you're getting a negative confidence shock right now. And so you're cutting government spending and not replacing it with private spending. That's where you're getting these worries about recession coming from.
So the logic at the White House among the Trump administration is that the reason you're doing this volatility, the reason you're trying to negotiate, in theory, the approach is shaky, but the reason is ultimately to bring about tax cuts and to bring in the deficit. The deficit ceiling or the debt ceiling hits in July. How much of that is the bigger risk to the U.S. economy?
I think the risk is uncertainty, and you have to manage the private sector. People are not ultimately. You want households to consume and businesses to invest. And if you elevate uncertainty to such level that everybody is going to freeze in their place, you're going to create such a downwind, such a headwind that then you're going to have very little space left to do anything that you had planned to do. And in fact, you're going to hit that debt ceiling wall potentially even higher because the tax receipts are not going to come in, right?
Is that the case for an insurance cut at the Federal Reserve?
Not yet. I think you heard Jerome Powell. We all heard Jerome Powell on Friday. As I was saying, we're starting from a position of strength. The U.S. economy finished 2024 really with huge momentum. So there is a bit of margin. And separately, inflation is still too high. So, the Fed needs to weigh both risks. But, it used to be that they only needed to worry about inflation. And now we're back in a place where they need to keep an eye on both inflation and growth.
So, Isabel, Donald Trump was hanging over another central bank last week, the ECB. And, of course, we had another cut, but a lot of uncertainty over the April meeting. The big question, I feel now, is whether this fiscal boost, in terms of growth, outweighs the tariff threat. What's the answer for you?
Yeah, we didn't get a whole lot of guidance from Madame Lagarde on this, and rightly so, because these are two big unknowns. Like, in fact, we might get neither the fiscal boost nor the tariffs, or we might get both, or we might get them on a different timescale. So it's understandable that they wanted to leave all options open for the April meeting. What's a bit disconcerting is that, we've heard from Madame Lagarde, we'll be data dependent, and if the data warrants a cut, we'll cut, and if it doesn't, we won't. But we're very unlikely to get that much more clarity about the data between now and the April meeting. Okay, maybe there will be a tariff decision, but as we've seen, it might be undone within 48 hours, so that won't give us that much more clarity. And then on the fiscal side, okay, we'll have had a vote in the Bundestag, but how quickly is that spending going to come? We still don't know, so very open for the April meeting.
But so let's say it's the best case scenario and the tariffs are light or non-existent and you get this massive fiscal boost. You've still got all of the problems in Europe, the ageing workforce. Basically, does stagnation continue?
Yeah, so I think it's the mirror image of the US a little bit. US, you're starting from a high level and you're having a lot of confidence activity indicators deteriorating. Europe, you're actually seeing a lot of green shoots in consumer confidence, business sentiment, investment, even manufacturing production, improving or deteriorating less, but still operating from a level that's below potential. So you've got really some room to go, and that has to factor in the ECB's thinking in terms of, do we keep cutting or not? Because you're not operating at full potential. There are structural drags, and so you would want to help that economy. But the good thing about the kind of fiscal boost that we're talking about in Germany in particular is that this really has the potential to improve long-term potential, not just a short-term boost.
OK, optimism. We thank you, Isabel Mateo-Silago, Chief Economist at BNP Paribas, but a lot of uncertainty to wade through in the meantime. Coming up, we'll talk Bitcoin, US President Donald Trump's strategic reserve, disappointing markets. That's next. This is Bloomberg.
reason why we need a Bitcoin reserve is that the federal government already owns some. In fact, it obtained around 400,000 Bitcoin over the past decade through criminal and civil forfeitures and seizures. And so the government has to have a strategy.
So that was David Sachs, the Trump administration's crypto czar. His comments coming after the US president signed an order on Friday creating a strategic Bitcoin reserve and an additional stockpile of other digital assets. Now, in reaction, you can see on the screen Bitcoin lower 1.2% this morning. Ether is up 0.8%, but of course it got hammered over the weekend. And so recovering somewhat this morning, higher 0.8%. But we can discuss more of this policy now with Elise Susie Watts, who is Executive Director of Global Digital Finance, and she joined us round the table, I'm pleased to say. Good morning.
Morning.
I wonder what you make of this executive order, a national strategic Bitcoin reserve. Is that a credible plan to reduce the US national debt?
So I would say there's actually two parts here, which is that you have, one is the digital asset stockpile, which is everything outside of Bitcoin, and that is for everything that the U.S. government has already seized. And to be honest, not a bad idea to do an audit of it, make sure they know what they have and that they're using it responsibly. And I think that's one of the things that David Sachs said that they don't have right now. The Bitcoin reserve is a bit different. Yes, it will include seized assets as well, and of course, it will be what the government already has. However, they also said that they wanted to increase government supply of Bitcoin in a very strategic way. However, here's the catch, and this is why I think you see Bitcoin down. They said they wanted to do that in a budget-neutral manner, so not increasing the national debt, which, as you know, is really important for this administration. However, I think that what markets expected was when Trump first announced it, that the U.S. government was going to buy. And when that didn't happen, they reacted a bit mutely to it.
So what are the realistic steps that you would want to see that would give greater certainty to US crypto markets then?
So I think really the Bitcoin reserve aside, what's important for markets is regulatory certainty, legal clarity, and we do see some small steps towards that happening right now. There's the Genius Act, which is going through the U.S. Senate banking, stable in the House, and we're also expecting a market structure bill in Q2. That will give the regulatory certainty that's really needed, and things, for example, like the repeal of SAB 121, the SEC accounting bulletin, which allowed institutional players to enter these markets. I think that's what's really critical in terms of the larger digital asset market outside of just crypto and meme coins to grow and scale.
When you talk about maybe what's driving some of these trades, at least on a kind of day-to-day basis, walk us through how the dollar fits into that equation, just given that it feels like Donald Trump has been, yes, pro-Bitcoin on the campaign trail, but also anti-dollar, and kind of he wants that weaker dollar. But that's also factors into trades and certainly the mining of things like Ethereum, for example. How do you filter in the dollar case?
I think this is really interesting, and this is the other question that a lot of markets have been asking. You know, you saw actually a lot of people coming out on kind of crypto Twitter over the weekend being like, Bitcoin strategic reserve is not very strategic. We don't know why they're doing this. Or I've heard others say that actually a strategic reserve makes sense for almost any other country besides the U.S. Because you do have to wonder when you think about a strategic reserve, where we've seen this previously with like the U.S. Petroleum Strategic Reserve, that's for a commodity that is widely used in day-to-day life. No more oil, everything shuts down. That's not the same for Bitcoin. And so I think there are a lot of people questioning what this means for that petrodollar dominance and if actually Bitcoin will become the next underlying backing asset for the US.
But isn't there a contradiction? There's a contradiction. The Trump administration is really keen on the dollar, wants to make sure that the dollar remains in its preeminent position. But isn't Bitcoin just a massive threat to that?
And I think that, yes, you're right. And I think this is the question everyone's been asking. And long term, we don't yet know how the strategic reserve will play out. But the truth remains that the U.S. government already has a massive stockpile of Bitcoin. And so I think the ambition to audit that and see how it can be used more effectively isn't a bad one. I think, though, it's this question about acquiring more Bitcoin over time and then what they do with that no one really yet knows the answer to.
Fold in now the energy conversation as well. Hasn't this been kind of taking off in places like Texas, for example, where you do have that access to energy, places in the South that can provide that really cheap energy story? We talked about the dollar a little bit. If you start to see an increase in energy prices, does that undermine the case for some of the crypto exposure?
So I would say in this, you really have to divide out the market. So there's a huge difference between Bitcoin, Ethereum, meme coins, and things like stable coins. Sure. Not all use huge amounts of energy consumption. Stable coins, for example, with fiat backing, that has, absolutely not the same impact as something that's proof of work and needs mining like Bitcoin. And so I would say it really depends on what part of the market that you're looking at. But for a lot of institutions and, the more traditional financial markets, they're looking at the underlying technology of DLT. And so actually on the energy side, that's not necessarily something they're concerned about because you can use other mechanisms like proof of stake, for example, which are a lot less energy intensive.
What else is going on? The crypto market seems to be in flux at the moment. You've got hacks, you've got all kinds of other things happening that are calling into question crypto's ability to deliver on its ultimate aim. And I'm wondering whether, as we focus on what is happening in the United States with the Trump administration, we're missing other cracks that are opening up.
So I wouldn't say it's cracks. I would say that this is a journey of a market maturing. And a lot of the regulators are certainly looking at this and thinking about how they mitigate it. So if you start at the global level, standard setters like IOSCO and the Financial Stability Board are looking at, the financial stability implications of stablecoins and using crypto assets in financial markets more widely. You also have in the UK, for example, the FCA set out their crypto asset roadmap. And so regulators are grappling with this. But to the point you raised about the hacks, that's why it's so important to have a clear regulatory framework. We need a framework for market abuse. We need a framework for, to prevent these things from happening. Operational resilience, cybersecurity.
But isn't there a broader concern that those setting the rules also have skin in the game, particularly when it comes to the Trump administration?
Yeah, I was about to say, I wouldn't necessarily say that's true of all regulators. This is definitely a concern in the U.S. And, we saw last Friday there was the crypto summit where it was some of the biggest players in crypto all around the table talking about what's needed next for the U.S. in terms of digital asset strategy. Now, inherently, that's not a bad thing. I think public-private sector partnerships are very broadly good, and feeding back those technical policies is great.
But the line is very blurred.
Not if it benefits them directly. And so I do think that that's why it's important to have the appropriate disclosures, due diligence, conflict of interest, which, should be being adhered to, but I don't work for the U.S. administration.
OK, so those difficulties, at least in the U.S. situation. But in terms of regulation more globally, how do you see it being different in the US and Europe, the challenges facing regulation on crypto?
So in this sense, the EU is miles ahead. Their markets and crypto assets MiCA framework, it's rolled out, it's implemented. You can already get a license in the EU and passport across EU countries. UK a little bit further behind. We only have the registration for AML and counter-terrorist financing as well as financial promotions. However, in the EU, they've been working on their framework for ages. And I actually think that there's a lot of lessons that the US can learn as they start to build out their stablecoin frameworks and market structure in Q2.
Where does the Federal Reserve fall into all of this? Because we talked about how Europe is ahead in some ways, including perhaps the introduction of, say, a digital euro, for example. The Federal Reserve is kind of dragging its feet on a digital dollar. Does increased usage of stable coins maybe hurry that process along?
So I would actually say no. I think that the U.S. is taking an alternative approach, and that's what the Trump administration has said, is that they don't want a digital dollar. And so instead, I think in the U.S., we will see stable coins filling the gap that a digital dollar might fill, whereas in the EU, they still have a huge focus on monetary sovereignty and have made their plans very clear to continue with the digital euro. So I think it will be a kind of tale of two approaches, and we'll see which one wins out.
If U.S. stocks go down, if U.S. tech goes down, does crypto follow?
Probably. Honestly, at this point, yes. I think there are a number of other things that are affecting crypto volatility. It can be politics, macroeconomics, geopolitics, but broadly...
But that link is there and fairly strong.
The link is still there.
Great to see you. Elsie, thank you very much indeed for stopping by. Elsie Cici Watts, Executive Director of Global Digital Finance. Thank you very much indeed. What's going on with futures this morning? Europe up, US down.
It's an interesting one because it's almost a reversal or even a continuation maybe of a trade that we saw last week. We don't really see that on Monday mornings, but nevertheless, you are certainly seeing European futures higher this morning. When you look at the stock 600, a little bit of optimism there. You are looking at it higher by about 0.6%. The CAC Iran also on its heels. The DAX going back to a trade we're familiar with, being the outperformer.
This seems quite logical, though, in some ways. We did see a US rally late in the day in somewhere in the United States, which has got to be folded into Europe this morning. The US is kind of one step beyond that. So we're kind of still responding to what we saw Friday here, but US futures are rolling over, which I think is a pretty bad omen for the beginning of the week and what we're looking at in terms of all of the events that we've got to get through this week. S&P futures down another 0.5%. So it feels like, again, we're starting on the back foot with US assets, which is obviously the lead indicator.
Can I make the contrary argument that maybe a 0.5% drop isn't that bad, actually, considering the reciprocal
these
tariffs
days,
over
no.
China? Exactly. I mean, when we saw these kind of tariff moves, you would see a 1% at least move in another direction. Is this perhaps a little bit of complacency baked into this market Monday morning?
There's so much more to get through in terms of our understanding of what's going to happen this week and the flip-flopping in terms of the tariff story. But it's a big week for data. Yeah. And the market's got to get through all of that data and understand where the US economy is left. The question coming into Monday morning is the US facing a recession? Are we going into a Trump session? Is Trump going to cause, along with Elon Musk and all these other people, a recession in the United States? Because the market is not... That is very bad news for stocks. We don't know the answer to that question. Is it just an air pocket? Is it buying opportunity?
Yeah.
The data this week will provide us with some clarity on that.
Well, you know, what's also interesting is that we need to see if some of these yield moves that we see in the last week kind of come back down to earth, specifically when it comes to Europe, and how much of, say, the German yield picture, the UK yield picture is a function of that US data, or maybe there is a lack of credibility question when it comes to some of this fiscal bazooka as well. You've seen this massive surge in yields. Does it come back down to earth?
Yeah, I mean, one of the interesting questions to Christine Lagarde on Thursday at the ECB meeting was about what happens if you see the spreads widening in Europe off the back of the fiscal spending. And, you know, she was very clear in saying that it's not the ECB's job to finance defence spending, but she doesn't need to answer the question yet on whether the spreads widen and what the ECB role is there. What's the answer?
Yields going higher is OK for Germany. Germany can tolerate this. It's got a very low debt-to-GDP ratio. But if you're Italy, if you're France, if you're the UK, then it's hugely problematic. And I don't think... We haven't completely got a formed thought yet on what is happening here in Europe. Germany has changed the game, and the ripple is still spreading out from that. We don't yet know kind of the significance of some of these other markets, some of these other countries, and what it's going to mean to them.
With the March 26th spring statement coming up for Chancellor Rachel Reeves, does she need to take the cover from the defence argument that's very much been taken in Europe and Germany and actually change her fiscal rules when Britain is frankly broke?
Absolutely. There's very little money left. Coming up, we're going to talk about what is happening with the single stock story. Rio Tinto has said to have scrapped plans to raise as much as $5 billion in a share sale following pushback from investors. We're going to discuss that next. We'll talk about all of the stocks you're going to be watching into the open. Remember, the United States is only 4 hours away at the moment. At 8 o'clock here in London, we'll also get pre-trade in the United States. We'll bring you all the details of that over the next few minutes. That's coming up. This is Bloomberg. 14 minutes to the equity market open. European equities are expected to open higher this morning, despite the fact we are seeing US futures ticking lower. Back into the US session Friday may have something to do with that. We can probably look at Jay Powell and think about what he said Friday about the US economy. But as I say, 13, 14 minutes to go to the equity market. But let's talk now about what is happening in the agricultural space. It's time for farming today. Kriti, what's catching your eye?
I mean, what a setup. Is farming ever really that juicy? I promise you it is right now, because that is the #1 export when it comes to the relationship between the United States and China. I'm having a little bit of deja vu from the first Trump administration, where that farm deal was negotiated, really requiring China to buy so many of U.S. agricultural products, specifically soybeans and corn. Those are two of the top exports that go from the United States to China. And I should mention the United States to the rest of the world. Well, let's talk about what that tariff move actually means from China in terms of the overnight story. On Saturday, they're announcing tariffs that kick in today to the tune of 10 to 15% on some of those exports. It includes things like grains, protein, cotton, etc., and fresh produce, among many, many others. What they've already done, though, is halt some of the imports when it comes to American soybeans. This hurts American farmers, specifically in the middle of the country. This is going to be crucial. It also has already stopped purchasing timber from the United States. And this is a big deal because it speaks to this idea of how economies around the world can potentially position and diversify away from the United States. But this isn't something that happened in just the last 48 hours. It's been in play for some time. And this is where I want to bring you this chart right here, which shows really the difference when it comes to where China is getting its soybeans from. And remember, this is something that they use for kind of animal feed, they use it for homes, they use it for kind of mass consumption, and then use it to refine and push into other products as well. Now they are starting to consistently, and it has been the case for about 2 years or so, get more of their soybean purchases from Brazil over the United States. Now, bear with me here. This line from in blue is the imports from Brazil. The line in white is the imports from the United States. You can see that it's kind of had an inverse, almost cyclical relationship. But in the last 2 years or so, consistently, more purchases from Brazil than the United States. Guys, this is how you prepare for a potential change in where you get your food.
Absolutely, and this is going to have a meaningful impact in terms of inflation and prices and everything else that we're watching so closely at the moment. It's interesting that what we are seeing is things like rapeseed oil dropping really sharply in Canada. We've seen prices coming down as a result of potentially these sanctions having a meaningful impact on that market. And that ripples through into all kinds of other places. This is a key input, for instance, for some of the new diesel, more sustainable diesel products that are being produced by refineries, sustainable aviation fuel and other products that comes off that market as well. Again, the disruption that is being caused here, really significant. And it just comes back to this idea that we're really struggling, I think, to get a handle on what the economic implications of all of this are going to be. We're waiting for the data to catch up and tell us what is happening. At the moment, we've got soft data that's giving us some clue. We're kind of understanding how the markets are kind of trying to front-run this. But the accuracy of that ability for markets to price all of this feels really, really, really thin at the moment.
Yeah, I mean, I was talking to an ECB policymaker on Thursday about this and saying, you know, there's this lag in monetary policy. Don't you want to get ahead of the tariff threat to growth when you know there will be one?
Yeah.
And they were saying, but we don't know what the level is. You don't know the retaliation. You've got all these different fronts, as you say, China and Canada putting tariffs on each other. There's just no way that you can preempt that as a policymaker.
So you have to look at lagging data, which ends up raising the risk with such turbulence of a policy mistake, doing the right thing at the wrong time, or the wrong thing at the right time. You just don't know what you're doing, and therefore you find yourself in a situation where the volatility in markets, as it tries to price all of this, just becomes greater and greater and greater. Anyway, let's try and get a take on all of this. Paul Dobson joins us now, Bloomberg Asia Markets Executive Editor. Paul, what are you looking at this week? We've just come off a week of massive volatility. We're worried about a US recession. We've got sort of Chinese data we're trying to fold into the mix as well. Europe looks like it's doing its own thing. What are you looking for this week to provide clarity?
Yeah, morning, Guy. So I think that there are a few market indicators that we'll want to pay particularly close attention to, given this sort of slight ratcheting that we're seeing and concerns about the US economy and the growth outlook, and whether indeed, you know, people are getting more worried about a recession. One of them, the Treasury yield curve, pretty important. Looking at that sort of bull steepening that we're seeing, where we're seeing short-term interest rates fall quicker than long-term interest rates, which means that people are betting both on a slowdown and on the idea that the Fed is going to have to cut more aggressively. Have a look at junk bonds yield spreads in the US as well, widening out quite aggressively over the past couple of weeks. Pushing to multi-month highs again, showing a little bit of stress there that hadn't really been on the radar too long ago. And then, of course, you know, in the retail space, I think the sentiment there is really important at the moment. We're seeing that show up in the declines in cryptocurrencies that we've seen over recent weeks, and in some of the survey data as well. So the American Association of Individual Investors found that for the first time since 2022, more people in their survey thought that stocks would be lower over 6 months than they would be higher. So that sentiment is definitely starting to shift, and I think that some of those metrics may give you more insight into exactly what the market sees as coming next.
Paul, we're headed into a week full of data, as Guy had mentioned. I'm looking at a 10-year at 427 over in the States. How low can yields go? What kind of data print do we need to see a bigger drop in yields?
It seems like people are quite worried about the data, quite worried about the economic surprises coming in to the downside. And, you know, on the flip side of that, of course, you've got in the back of your head the worries about inflation that might hold up bond yields. And that's why we're seeing a little bit of that steepening there of the yield curve. It feels like the other thing that you've got to factor in mind is just sort of the overall risk and economic tension and stuff like that. But on the other hand, if you look at what the Fed's been saying, they've been saying we're quite happy to hold interest rates here. We heard it from Powell on Friday. We heard it from Mary Daly as well. Quite a strong message that they're not preparing to move interest rates anytime soon. So that may prevent yields from falling too aggressively from here.
Paul, just in our last 30 seconds, let me ask you guys' favourite question. If we see the US stock market continuing to fall, how much does that spread over into Europe?
That's really interesting, isn't it? You would expect, all things being equal, that if people were really worried about a US recession, that would at some point start to impact the rest of the world as well. Not seeing it so far. We're seeing European futures up for today, for example, still buying into that growth story instead. I think, you know, people will get more worried about this if that pressure continues to ratchet up, and then it will start to spread.
All right, Paul Dobson, Bloomberg's Asia Markets Executive Editor, we thank you. But let's look at some of those individual stocks that could be on the move at the open. Joe Easton from our equities team is here to set us up. Joe.
Morning, Lizzie. So Porsche Automobile Holding announcing an impairment of around 20 billion euros after the close of trading on Friday. And this is the reason why two of their biggest shareholdings over the past 18 months or so have slumped. That's Porsche AG with the P911 and also Volkswagen as well. The competition from China and also recently the tariff situation weighing on those investments and therefore reducing the value of those. And that is the reason we could see some weakness on that one today. Then in terms of Rio Tinto scrapping plans for a $5 billion share sale. According to Bloomberg sources, that money was going to be used to finance one of their lithium takeovers in America, but it's faced some investor pushback on that one, so they do look like they're moving away from this one. A lot of buy ratings on that one, 17 at the moment. They might be a bit more happy this morning. Then in terms of WPP, potentially looking to break up and even sell the Kantar business. They're only a partial shareholder in this now because Bain Capital actually owns the biggest stake, but potentially a positive for a firm that recently dropped following very weak results from WPP. That could be positive. Analyst ratings, the pick for me, BAE Systems, downgraded in defence. Keep an eye on that, among a couple of others this morning.
All right, Joe Easton, our equities reporter, walking us through some of the analyst changes that could yield some moves in just about 5 minutes' time. Coming up is the opening trade. We are seeing a little bit of a mixed picture in futures because positivity in Europe seems to be the name of the game. Outperformance in the DAX. U.S. story a little bit different. The opening trade is up next. This is Bloomberg.
Monday morning, good morning. I don't think there's anything mysterious or strange about the fact that this morning European futures are pointing higher and US futures are pointing lower. They're on different timelines. Let me just explain briefly. European markets Friday go out here. US session lows. Powell then speaks, US markets get into a rally, and as a result of which we finish significantly higher. Europe just basically has to price that gap in this morning. That's why you're seeing what you're seeing, or at least what Lizzy is about to show you. US futures are lower. This speaks to maybe the uncertainty that exists after a weekend of frenzied discussions surrounding whether or not we are going to see a US recession. Remember as well that this chart is about to be offset by an hour. The US clocks have moved, ours haven't. We're only separated by 4 hours from New York right now, Lizzy.
OK, so maybe it all makes sense. US futures down, European futures higher, but it's green across the screen, as you can see, as we head towards this session, Kriti. We've got the DAX outperforming, kind of in a world of its own in terms of the futures at the moment. FTSE futures not as high. Maybe that's a bit of the China story, but you're looking at the individual stocks.
I absolutely am. Some deal flow that we want to keep an eye on here. I'm going to start with Rio Tinto axing their plans, forget this, up to a $5 billion share sale. So we're going to see how that's digested in the markets this morning. We've got another eye on WPP as well. This is after it looks like the Kantar owners, Bain and WPP, are planning a breakup and a sale of the group. That, according to some FT reporting, we'll see whether the markets digest that well. And then lastly, we should talk about Asura as well, potentially getting a possible offer from KKR and Stonepeak, a little bit more private capital entering these public markets, Guy.
OK, Kriti, it's time for Monday morning's opening trade. Let's give you some numbers, give you an idea of where Europe is opening. Critically, where does it go from there, I think, will be a question that we'll watch over the minutes that follow. So let's start with the opening trade. We'll work our way forward from there. FTSE 100, as we've already indicated, will be opening higher, but it's a confusing picture, as you can see. It's not that much higher. In fact, we click into negative territory already on the FTSE 100. Lizzy was indicating that it's likely to underperform some of its European peers. We're already seeing evidence for that. Maybe this European Open this morning won't be quite as glossy and green as we had originally had anticipated. We are getting some green on the screen, but remember, we're reacting to what we saw in the States Friday, the Powell commentary, the good news that came through from that. Maybe had a little bit of cold water poured on it by Donald Trump and the Treasury secretary and plenty of others over the weekend. Not so concerned about the stock market, it seems, or the economic short-term performance. The CAC is up. It's up by around 0.5%. We will await and see what exactly the DAX does this morning. It, once again, appears as if it will be the outperformer. Lizzy, what are we seeing in the sector story? Break it down for us from that direction.
Well, as we wait for the DAX guy, we are looking at all but two sectors in positive territory this morning, as the futures had indicated. And you've got travel and leisure leading the gains, so that's up more than 1%, followed not far behind by consumer products and services. That's up 0.7%. But bottom of the basket, we've got telecoms, we've got utilities, food, beverages and tobacco. They're some of the underperformers today. But we also talked about some of those individual stocks that we should have been watching, and we've got Rio Tinto up 1.2%, despite the scrapping plans for that $5 billion share sale. WPP also in the green, up 1.3%. And you were talking, Kriti, about the Kantar owners looking at a breakup of the sale of the group.
Yeah, absolutely. And that Rio Tinto story, I mean, not surprising that we're seeing that upside move. It basically means that you're not seeing a dilutive move into those Rio Tinto shares when it comes to the $5 billion, so higher by about 1.2%, as Lizzy said. But when you look at the bigger movers, the bigger players, guys, sensational six, core six, whatever you want to call them, they're certainly sensational this morning. I'm looking at LVMH, which is, of course, moving the pack to the upside. You're also seeing a lot of energy movement as well, which I think is interesting, Guy, given that on a macro basis, you are looking at oil not moving that much in a positive direction. You look at Shell, Total, BP, and that's a completely different story.
Yeah, you got a move in Ryanair, which I need to come back to and just figure out. It looks like that company's stock is trading up quite sharply. I just want to get the details of that and just understand a little bit what is happening there. We'll come back to that in just a moment. Broadly, though, this is a market that is looking back and now has to look forward. And it's going to be interesting to see how long the initial kind of positive move lasts for, given the fact that we are going into a US session which looks much more significantly lower and actually is only 4 hours away when it was normally 5 hours away. We'll have to price that in even more quickly this morning than we normally would have done.
And yet, another day where these defence stocks are making significant gains. Hensel up 4.8%, Thales 3.3%. Same move for Rheinmetall. It just doesn't seem to stop for these defence names, off the back of this expectation, of course, that Europe's going to spend more for its own defence.
Absolutely. We're talking about what else is not performing well, and that, of course, is the telecom sector. It's your only sector in the red this morning. Deutsche Telekom taking a big hit of that. And, of course, a lot of the biotech names I should mention. AstraZeneca, Sanofi also taking a little bit of a hit as well. Let's bring in an expert about how you deal with all of these market moves. William Hobbs joins us around the table, head of UK multi-asset at Barclays Private Bank and Wealth Management. You've picked a great day to join us. Thank you so much. You can probably make sense of everything that we are seeing in some of these markets.
That would be amazing.
I mean, go for it. Go for it. Your initial take here.
That would be amazing. So it's so interesting. The question about US recession, I mean, we're still not there yet. I mean, for us, the US economy is still in such a good situation from before the Trump administration took hold. You know, you've got, if you're entering the meat of an industrial revolution, then the US corporate sector's still owning important chunks of that. The US consumer is still formidably tooled up. I mean, I think we had reports from one of the regional feds showing that the US consumer in net asset terms still has grown its assets by around 50 trillion since the last quarter of 2019. So that's a big starting point. But what you are seeing, and I think you had a guest on earlier, Isabel, talking about the uncertainty tax. And as we know, like a lot of decisions about investing, hiring, they require a degree of visibility around what's going on. And you've got this US administration that seems to be trying to blow the froth off the US exceptionalism bit, so that's forcing investors to reevaluate. And the really interesting bit, because I've seen this a few times during my career, that, in the last 15 years at least, you've seen a few moments where US exceptionalism has been questioned, but during that period, there's been very few contenders. And right now, you've got Europe sticking its hand up, maybe China if it can do a bit more on the consumption side of things. So it's a very interesting world for investors, I think.
Let's zero in on Europe for a moment, because it almost feels like they're using a little bit of the Biden playbook here. And stick with me as I make this case. It's simply that as the government spends more money, stock markets rally. And you've seen it in Spain, you've seen it in Italy, you're now seeing it in Germany, not just in the defense sector, you're seeing it in pretty broad-based gains as well. Is that the trick to making a regional stock market rally and outperform? You need the fiscal spend.
Well, I mean, I think, you know, in Europe in particular, you've had this kind of demand deficit alongside the kind of well-talked about supply-side stories that Draghi and others have highlighted. And Germany in particular has been long thought as sort of one of these sort of major players in that demand deficit. So the degree to which, A, you assume that everything that the shortly-to-be Chancellor Merz has promised will go through the Bundestag and ultimately the Bundesrat, that's one question. How much of that defence spending leaks out as imports, that's another question, and whether you can actually start prepping your industrial base to start owning a bit more of that story. But really, I think quite a lot of it is just about that kind of co-investment story. So the fact that Europe is getting a demand story going is giving international investors as well as domestic investors a bit more confidence. And Europe has quite a lot going for it that I think is being underestimated in many ways, just because it's been seen as a basket case for the last, you know, increasingly for the last 10 years, I think.
I'm going to let our other co-anchors maybe dig into some of that optimism around Europe as well. But I want to dig in first on the Germany story.
Yeah.
The clock is ticking on whether that promise, the investment promise, is actually credible. March 25th, I believe, is the deadline. What kind of market dislocation are we looking at if that 500 billion euros doesn't come through?
Yeah, I mean, I think that would be quite a disappointment. I mean, there seems to be quite a lot assumed at the moment, and we would be still a little bit cautious. I mean, you know, even with the Bundestag, we don't know that the Greens are on side just yet. And the Bundesrat, I mean, they have thrown a few sort of little bits of candy with regards to the, you know, the federal easing of the deficit restraints. So maybe that makes things a bit easier. But yes, it's not nailed on just yet, I would say. But there is a lot of pressure for any holdouts in the German parliament. There's a lot of pressure now going on, given what the EU has now assumed and how the markets have reacted, I guess.
I mean, Kriti, you remind me that actually that's the day before the UK spring statement from the Chancellor Rachel Reeves. Do you think, William, that actually she could do a bit more? She could take this opportunity here, use defence as political cover, and actually tweak the fiscal rules and get away with it when it comes to the bond vigilantes?
Oh, Lizzie, that's a big question. I mean, personally, I mean, I was quite surprised in some ways, or at least there was an interesting comparison between the budget that Prime Minister Truss and Kwasi Kwarteng went through and the fiscal expansion that the most recently happened, and the market response to the two. And in a way, quite a lot of it was about communication, wasn't it? The sort of credibility of how you describe what you're going to do and the debt increase as a result. I'm not sure, and if you look at how the term premium in the UK has widened in that period, I'm not sure how much scope further the bond markets will have, and there's already a few concerns about the UK. Personally, I would be a little bit more optimistic about the UK. The cyclical picture does look a little bit stodgy. But I think, like everywhere else, you've got this industrial revolution happening, and the UK's advantages are probably understated. But I'm not sure they'd get away with, after doing persniffle, I'm not sure they'd get away with another change, personally, but yes.
OK, but does that optimism translate to equities? Because look at just this morning, you've got the DAX up 0.3%, the FTSE up, well, just flat to the upside. The FTSE 250 may be up 0.4%, but my broader point is, does the bull case for European equities diminish the case for the FTSE?
Not necessarily. I mean, so in the three main positions we've had on since the start of the year, so we've had a positive euro position, was euro dollar, now euro GBP. We've got a positive mid-cap UK and a positive China, MSCI China. Now, those three positions stand, I think, and they're basically a function of that idea that maybe the exceptional nature of the US was exaggerated and the unexceptional nature of the rest of the world was also a bit exaggerated. So we're leaning in those directions still, and I think there is still an opportunity for UK. Certainly small and mid-cap. I'm not so sure about the large-cap space, but for long-term investors, there's plenty to like about UK large-cap if you think the dividends are sustainable and dividend growth is broadly plausible.
In the near term, though, how much do I have to worry about a US downdraft? It's fascinating. In euro terms, the DAX is up 15% year to date. The S&P in euro terms is down by 6% year to date. That's a pretty big swing in the Europe's favour. If the US downdraft continues, can that spread continue to widen, or does ultimately Europe get infected by that US pessimism that's beginning to permeate stocks? I appreciate they started from different points, but they have a gravitational effect on each other.
They should do. You're entirely right, Guy. I mean, the US remains the whale in the bathtub,
Yep.
in terms of global capital markets. If you look at the long end of all yield curves, they're mostly explained by what's going on in the US. If you look at markets, the overwhelming majority. So I would still assume that that would be the case if you had a real US downdraft, a proper US downdraft.
But how does it work? Does Europe underperform or outperform in that scenario? This is the question I keep asking. Does it go down? The US goes down 10%, and in euro terms, the Nasdaq's now down by 10%. Does Europe fall 5% or 15% as we see this all kind of washing its way through? What's the beta? Is Europe a safe haven in this, or is it the centre of the storm?
That's a really interesting question. I wish I knew the answer for sure on that, Guy.
So but when investors come and ask you right now, what do you do?
That much will depend on how Europe and China use this moment. Because what you've got, in a sense, as you know, is that both of these areas have got difficult policy trade-offs to enact.
Yep.
And an external enemy is quite helpful in this, right? And I'm not calling the US an enemy, but certainly an adversary. Now, if Germany can continue to make progress, and Europe, and use this as a sort of Alexander Hamilton moment, then I would assume, actually, in the next 6 months, that almost it doesn't matter what US will do, that you should continue to see Europe
You should allocate to Europe.
Yeah, because that will be a really interesting long-term opportunity. If you're genuinely getting, a military union being used as a backdoor for proper fiscal union, that suddenly makes Europe way more investable, I think, for long-term investors, and you'll start getting a much more attractive position. The same is also true of China to a degree. If you start seeing the enactment of a consumer package, as we're being dangled with at the moment, proper hukou reform, that starts to make these areas much more attractive.
It sounds like US exceptionalism is over.
But I was going to say, it's a point that was made by the former Australian Prime Minister Malcolm Turnbull on the China show just this morning. He was saying the more that Trump looks chaotic, the more Xi can look consistent, the more he can appeal to Europe to do business with China.
Yeah. I agree. And the interesting thing is, I mean, we're still having this problem with the US administration of just sort of, this seriously, literally dichotomy. How do we take all this? Is this really an attempt to kind of totally reorganise global trade and everything with it? If it is, then other areas of the world are going to look quite interesting given those valuations. And the interesting thing, I think, is that the global capital market pricing and valuation spectrum is encouraging you, in a sense, to be imaginative about how this next phase of the Industrial Revolution plays out. We're beyond the picks and shovels phase. Time to get inventive.
Time to get inventive. Words to live by. William Hobbs, head of UK multi-assets over at Barclays Private Bank and Wealth Management. Thank you very much indeed. Let's take a quick look at what we're seeing at the centre of gravity here in Europe this morning. In terms of the core six, we look at a picture that is largely green. It's interesting that LVMH is unchanged. ASML is a little under the weather, but not by much, as is LVMH. But actually what is interesting is that we're not seeing a significant sense of direction in any direction this morning. Novo Nordisk is not doing very much. Nestle, the defensive end of the spectrum, not doing very much. ASML, in the sort of tech direction, not doing very much. Europe, I think, is waiting and watching, trying to get a sense of where it should go next. But there are some individual stocks that are really on the move this morning. Let's get the details of those with Joe.
So one of those stocks on the move, Guy, is Ryanair. Now, this seems to be related to them allowing non-EU nationals to buy the stock. That's been a weight on the demand for the shares, but that is moving the stock higher as that change is going to come into play. It did go into a little bit of a trading halt earlier, I believe, but it's ticking up now, up 3.6%. One of the best performers in Europe over in Dublin today is Ryanair. Then, staying in aerospace defence, getting a boost. We did see further headlines over the weekend around pressure to push up spending. Some comments from the NATO Secretary-General potentially adding to the positivity for that sector today. Already re-rated a lot, of course, this year, but Rheinmetall heading higher up towards €1,138 on that one. Those stocks up around 45-50% this year already. Then in terms of Rolex watches, Watches of Switzerland selling lots of Rolexes and therefore doing a bit of a share buyback, according to a statement that hit the wire at 7 a.m. here. The UK retailer has been on a downward trend in terms of their stock, but this potentially going to help a recovery in that one. So Watches of Switzerland up around 6% at the moment, one of the best performers in the UK, but not as good as a company that does the GP practices, all the GP surgeries, the buildings, they own them. It's a company called Assura, and they've got a takeover coming from KKR in private equity. KKR actually pushing up the offer price, and that is spurring a big gain for that stock today. Assura, potentially, this is going to get over the line. Americans once again coming over and buying up all our companies. Assura up 14% this morning. Then we move over to Silit Bang, Reckitt Benckiser. This one downgraded at Bank of America following those weak results that we saw last week. Bank of America saying it's a transition year for the household goods maker, and therefore they go down to neutral after being long-term buyers on that one. And the woes continue for BT. Finally, this stock getting another sell rating. Barclays going underweight or underperform on BT. I think this is probably tied to weakness in the open reach business. I'll have to get my hands on that note, but that stock is falling. It was down 3% at the open. It's come up a little bit, down 1.4% a weekday for BT once again in London this morning.
Joe Easton from our equities team walking us through some of those early movers, 60 minutes into the opening trade. We should also mention, because of the time difference for the next 2 weeks, we're also getting initial pre-market trades over in the United States. And there are two key places you want to look for the moves. I'm going to kick it off with some of the big tech names here. When you look at NVIDIA shares, for example, down about 2% this morning. You'll see a big move in Tesla, down about 2.5%. Meta, same story. And Amazon also taking a hit. Now, those are your big kind of mega cap movers, but you're seeing plenty of other tech names in between. Palantir, Micron, Dell, Google, and even Netflix all taking a hit to about the same tune. I'll also get a quick check on the crypto stocks as well, because we are seeing a pullback when it comes to the crypto story. And 82,000 is where we are on the cryptocurrency. That being reflected in a big way when it comes to those stocks. MicroStrategy, Coinbase, and Marathon Holdings, from the exchanges to the investors to the miners themselves. Lizzy.
So that's where we stand as we head towards the Wall Street Open. But we are going to stay with the US next. Donald Trump looking to achieve the US energy dominance he campaigned on and boost his geopolitical leverage across the globe. That's our big take. We're going to discuss it next. This is Bloomberg. Welcome back to the opening trade. Welcome back to the opening trade. We're 21 minutes into today's session, and that risk-off mood that you're seeing in US futures has now infected the European session as well. So the stock 600 flat to the downside. The DAX still in the green, just as is the CAC, but the FTSE 100 also down 0.2% as things stand. Guy, it was going to happen at some stage, wasn't it?
Well, it was going to happen quite quickly. We priced, as we came through to the opening trade, the Friday story. We went out at US lows. US then rallied. We need to price that in. That's fairly straightforward. Now we look forward, and a US market that looks quite nervous this morning, certainly big tech under significant pressure. Let's talk about the energy sector, because we've also seen some weakness in the crude price as well that is worth paying attention to, and talk a little bit about the bigger picture and the narrative that we are watching here. The US has elevated itself from what was once a tiny player in the liquefied natural gas market into effectively the world's largest supplier. President Trump is now looking to take it one step further. He's looking to effectively achieve energy dominance. He talked about it during the campaign. Let's talk about this as our big take today, the geopolitical leverage that ultimately it gives the White House. Stephen Stepchinsky joins us now to take on all of this. Is this a weapon? Is this a tool? Is this a geopolitical tool that we should be thinking about gas in terms of right now? Do you think, Stephen?
You know, when you look at this as a geopolitical tool, yeah, I mean, this is the one area where you're going to see the U.S. actually significantly increase exports. They became the world's largest exporter of liquefied natural gas a few years ago, and they're aiming to double, or they're on track to double, exports by the end of this decade. And this is one thing that the Trump administration has been pretty clear about. In order to cut the trade deficit with countries and regions from Japan to the European Union, they've been really pushing this view that you need to buy more oil and gas. Trump said it shortly after he was inaugurated. He said it on Truth Social, and he continues repeating that. But when you actually look at oil and gas, you look at the breakdown, oil production in the U.S. isn't really going to increase that much. It's more driven by the prices. And right now, prices are falling, so producers don't want to increase output. Gas, on the other hand, liquefied natural gas specifically, which is the way that the U.S. exports it on ships, that is set to grow and grow rapidly. And so because of that, that's one area that he's trying to take a bit of credit for, I'm sure, over the next few years, even though those projects were planned for months or years ahead, far before he was president this time. That all being said, countries are coming to the United States pledging to buy more gas as a way to get on his good side and potentially kind of get rid of a risk of these retaliatory tariffs.
OK, Bloomberg, Stephen Stupczynski with our big take. Want to read this morning, we thank you. And now I want to flip over to a corporate story. TSMC revenue climbing 39% in the first 2 months of the year, a sign of the resilient demand for the NVIDIA chips that, of course, power AI development. And we can get the latest on that with Robert Lee from Bloomberg Intelligence. Robert, good to have you. Just talk through what is the main read across from that sales number.
OK, well, thanks for having me on. I think it's fair to say the AI trade has undergone a bit of a wobble recently. If you look at NVIDIA's share price, etc., and the sort of weakness we've seen in the US tech sector. We've also heard some news recently, although unconfirmed news, that maybe Microsoft was cutting back on some of its data center rental. And obviously things have been shaken up by DeepSeek, haven't they, since the beginning of January. So I guess these numbers show that on the hardware or semiconductor side, things remain on track for the moment. They should provide a bit of a boost to sentiment. Sort of ties in with the positive news we saw from Broadcom last week. And also we had more locally here in Asia some decent, strong numbers on the AI side from Hon Hai. Having said that, I would just caution about reading too much into monthly sales data. They're notoriously volatile, and we've only got 2 months under our belt so far this year.
How quickly can this change? In theory, you look at what is happening here, you would say, actually, we should expect maybe the demand for AI chips is going to hold up. But how quickly can that alter? Is it simply a case that one day we're ordering a lot of chips, the next day we decide we don't want to order those chips, we withdraw those orders? How fast can this narrative shift?
I think, again, if you take into account the lead times on these things, the inventories, etc., in play, then you're unlikely to see a shift in the short term. But it comes back to, again, DeepSeek and this Jevons paradox that was talked about that probably only sort of academic economists had heard of previously. So I think that argument surrounding the democratization of AI that DeepSeek's technological breakthrough should deliver, in other words, making the technology available to all and therefore ultimately stimulating the demand, that's the main argument that the market latched onto. But we've yet to see the evidence of that. I'm not questioning it, but I'm just saying that the evidence is not there. So we'll have to wait and see how the year plays out. But the reality is, at the moment, in terms of AI semiconductors, then NVIDIA is really an effective monopoly. So I wouldn't expect any short-term upset there.
Great to see you, Robert. Thanks very much indeed for dropping by. Robert Lee of Bloomberg Intelligence on the NVIDIA story. Up next, we're going to take you to Germany. The latest on the government. This is Bloomberg.
This is the opening trade. We're at 30 minutes into today's session, seeing some green on the screen, but perhaps not with the same enthusiasm that we saw in the futures picture. Let me walk you through the price action here. I'm looking at Eurostoxx 50 that is basically flat right now. Still outperformance in the DAX, seeing a little bit of outperformance in the French index as well, but certainly not the almost 1% moves that we saw earlier in the futures picture. Now, a lot of this may have to do with some of the turnaround we're seeing in the U.S. picture as well, because the FTSE 100 is now negative, down about 0.1%. In the futures picture, it was up up by almost 0.4%. So that is a major shift as well. At the same time, we've seen futures move as well over in the States. So you are seeing, when it comes to the U.S. pre-market as well, some of the tech stocks take a little bit of a hit, and that's moving the entire index and yield down as well, Lizzy.
Well, Kriti, you talked about how the DAX is kind of in a world of its own at the moment. Let's dive into some of the politics that is perhaps behind that. Germany's Conservatives and the Social Democrats having agreed to deepen talks over forming a new government. Now, that's as pressure builds on the Chancellor-in-waiting Friedrich Merz to implement the sweeping reforms that have so excited these markets. But if they fail to bridge their differences, the door to right-wing populists will open wider. And, of course, that risks a rupture with the rest of Europe. Let's speak now to Bloomberg Germany editor Chris Reiter, who recently published a book on this very subject, and it's called Broken Republic. Chris, I wonder for you how far you think we are from an agreement on a new government as you gauge the temperature in German politics.
Yeah, well, we're certainly at least weeks away from a final deal. I mean, on Saturday, they went from what's called exploratory talks to coalition negotiations, so it gets a little bit deeper, it gets more serious. They break the topics down into working groups, and that gets into the real nitty-gritty, and that's really where the, I guess, the rubber hits the road. You know, it's where the tensions come out at that point.
Walk us through kind of this massive spending picture as well. I mean, we're talking about this enormous amount on infrastructure, on defense as well, abandoning years of austerity. How feasible is this? How credible is it?
Yeah, these spending talks, it's hard to underestimate how important they are for Germany and for the coalition itself. If this spending package doesn't go through, it makes it even more difficult for a coalition agreement to happen. Because Germany, as you said, it's been underspending for decades, and so it needs sort of this firepower to be unleashed. But the problem is obviously that it's not, in order to get this spending package through, it's not just a question of Merz and the Social Democrats coming to agreement. They also need the Greens. And because it's a constitutional change, so it needs a two-thirds majority. And the Greens have already made it, so they need the support of the Greens, and the Greens have already made it clear that they're gonna jack up the price for their support. Over the weekend, they've made some very sort of resistant comments about whether they would indeed support this package. So that's like step one. If that doesn't happen in the next couple weeks, then the road to the coalition gets even rockier.
Chris, this feels like an earthquake in Germany. This feels like a big shift. This feels like tectonic plates are moving. Is that the reality?
Yeah, I mean, I think like what we write about in the book, and we have an essay out today, is that the nature of this crisis is very different than crises in the past. I mean, we've had Germany as the sick man of Europe before, recently like 20 years ago. But what hasn't happened in the past is that Germany is facing challenges on all different levels. I mean, you've seen that in the federal election, where seven parties had a credible chance to get into the parliament. So that shows a level of political fragmentation that reflects sort of the underlying conditions within Germany, that society is just not so united like it was before. On the economic front, we talk a lot about the challenges Germany faces in terms of there's the auto industry crisis, there's the energy crisis, there's the industrial crisis. So the core of the German economy is also struggling. And so on top of that, what you have, and what has been reflected in the politics, is that you have society drifting apart from one another. Germany in the post-war period was very much dominated by this idea of shared prosperity. And as social inequality intensifies in Germany, that is fragmenting sort of the structure within Germany. And so Germany needs to find new ways to rally the society together. And so the level and the depth and breadth of Germany's crisis is really sort of unprecedented from what we've known before.
It's going to be fascinating to watch how ultimately unfolds, a new Germany potentially emerging as a result. Bloomberg's Germany editor, Chris Reiter, thank you very much indeed. Let's move smoothly from German politics to German equity markets. David Snedden, CEO and Chief Strategist at Snow Hill Consulting, joining us to talk about what is happening in these markets. And let's kick off with the DAX. Nice to see you. The DAX has had quite the rally, and we have watched in awe as it has unfolded. We've got to some pretty impressive levels. Do I continue to chase it?
Yeah, I think you summed it up initially, what a rally. I mean, with 35% up from the low in August last year, 15% this year, and I think equally as impressive has been the performance over the last 2 weeks. We've seen the equity decline in the US, and we've just seen Germany stall, and actually even still edge higher in balance. So I think, the underlying technical factors for the market remain strong. It's a very strong uptrend. The volume is absolutely fine. The breadth is absolutely fine. There's no major issues that are going on there. I think if you look at things on the macro front, the surprise data, the European surprise data has been very positive going along with that as well. I think the only question you probably have, or two questions you have at the moment, is one purely in terms of location for the DAX. We are right, as this chart shows here, right up against the top end of the trend from 2022.
Yep.
So the location point of view, you go, this is kind of tougher levels. And momentum now, not showing anything bad, it's just getting pretty overbought on a weekly to medium-term basis. So I think it's that location point of view that makes it a bit more challenging to be overly sort of looking for it to continue strongly. I think the risks in here are clearly if we see more of a breakdown in the US, maybe if we see more of a stalling in European data. And at the moment...
well, let's just talk about that US story, because it appears like you've got two different equity markets at the moment, reversing a trend that we've seen over the last few years. We're at key levels in the States. What are the key levels that you're watching for? And if the US breaks below these levels, can Germany continue to do what it's doing at the moment? Can the DAX continue to outperform?
So the key levels in the US, I mean, it's almost very simple binary key levels at the moment. I think that most of the market is watching. The S&P at the end of last week came down to its 200-day average, which sits around 57.30, 57.35. We're holding in there at the moment by the skin of our teeth. I think we're right on it this morning in futures. The equally weighted S&P is doing the same. That's still holding in the range it's been in for the last few months. So with all the weakness that we've seen in the US, are you at a point where we've broken some really more...
But if we break below those levels,
if you break below those levels, and I think the risk for the US is the next supports are probably coming in initially around 56.20 and then probably 5500. I think the key, though, is what we're not seeing is a breakdown in breadth and volume. At the moment in the US, those are actually staying pretty constrained. We've seen a bit of widening in credit spreads, finally, but nothing dramatic as yet. And so I think it's to make the call right here, right now, the US has broken down. I think we need to see more evidence of that, frankly, in the near term. I think if we did, if you sort of posit that question, if we do break down, given how strong the European outperformance has been, I think probably, in my view, the bias is we would still see Europe outperform on the way down. But location point of view, you could see a narrative where, actually, from just a location point of view, Germany's probably in the right place. It does see a bit more of a stall and it does see a bit more of a correction. So I think the elements are there for it, but I think on that we're dependent on the US.
Well, let's go cross-asset there then. If we talk about dependency on the US, how does the bond market react to some of these kind of, honestly, countering forces?
Yeah, I mean, obviously we've seen some spectacular moves in the bond market last week as well, with German bond yields obviously leaping higher and still holding an upward bias in terms of the technical view there. US bond yields have stabilized, but they're kind of stabilized in what is a big range. I think that the big narrative that has been over the last few weeks has been this compression in the yield spreads. We've seen 10 US Germany yield spread come in dramatically. That, again, it's interesting, is now really at these sort of really big support levels all around 150. So I think the immediate direction here is a bit more tougher to call, because I think we could see a bit of stabilisation in the 10-year spread. If you go with the front end, though, 2-year yield spreads, 2-year US Germany, we're actually already broken through some really some pretty decent technical levels already, and I think that goes hand in hand with the euro story and the euro dollar higher story. So I think probably at the front end we see yield spreads continue to come down. I think that's helped supportive of still the euro move higher, going higher from here. The long end is a little bit more narrative, but I think US yields on their own are probably just contained in a big range now. Still at the moment.
Well, yeah, where does the euro end up? Because you've got another chart of that, and actually the euro down today, but still at 108.
Yeah, it's had a great run in the last week or two, so I don't think that's, to see some type of retracement to that, I think is, clearly something probably being a bit overdue. I still think overall, with the dollar story as well, with the dollar weakness we've seen, as well as the euro strength, I think the euro move for me is not done yet. I still think we've probably still got a bit more higher to go, so I could see euro dollar up at 110, which is the breakdown point that we saw pretty much from the second half of last year. I think where you really start to think, is this a much more significant euro dollar move higher, is a long way away. I think you've got to start going well above 111.5, actually 112.5, 113 before you start to go, this is more of a bigger story.
What about about if there is a Ukraine peace deal, but it's not the one that Volodymyr Zelensky wants? It's something that he's pressured into. There isn't, for example, a US backstop. Is the market's peace dividend diminished?
I think the problem is the sort of the headlines coming out at the moment is the market's getting sort of swung aggressively all the time on different ways, and we just, I think at the moment the market is pricing in that will be coming through, I think, in my view, on balance, and that does keep the dollar weaker in here. And there's the narrative that I think the US wants the dollar weaker. It's a difficult one to call. I still think at the moment making the really highly convicted call when essentially Eurodollar's in a big range, when 10-year yields are in a big range, is a really challenging thing to do.
Walk us through then the dollar ripple effect on gold specifically. How does that, if you're worried about the world and you're trying to hedge, and you're trying to find a safe place, isn't dollar and gold supposed to move together?
I think that's happened over the last week. I think what has been very interesting with gold, and gold clearly again has had just a staggering run in the last 2 years. And I think on gold, what has been interesting is all the dips that we saw last year were really very light and well supported. And actually very light and well supported, even when you had headwinds from a stronger dollar and from higher yields. And I think at the moment we're seeing the same pattern again sort of this year. We had the stronger dollar, gold stopped. It stopped actually at some pretty significant technical levels, the top end of the trend that we've been in for 2018. Never mind, we've got this massive 3,000 psychological level in gold coming up. So I think there is the case in the near term that gold probably struggles around these levels just because of these narratives, and the momentum picture is tiring. But I think a weaker dollar, I think what's been interesting is gold is ignoring the stronger dollar and the higher yields last year, but it's going weaker dollar, great, I'm going with that still. So I think the long-term trend for gold is still very much up. It's just how much does a barrier 3,000 present to us over the near term. But everything else seems to be in the gold trend pretty fine. Strong central bank buying, strong flows, strong investor demand. So, yeah.
Broadly, markets are struggling with clarity. There's a lot of uncertainty around at the moment. Are the charts that you're looking at clearer or more hard to discern than they were 6 months ago? It's everybody else, all the other indicators that we're trying to plug in at the moment are really hard to discern at the moment what they're telling us. Are the charts telling us a clear message, a more clear message than maybe they have been for a while?
I think yes, and clearly for myself, as predominantly having been a technical analyst for many years, and actually mixing in technicals and macro, this is the type of environment where having some type of technical overlay comes into its own, because you're trying to cut through the noise. And I think how we used it last week, the signal and the noise, and this is what we're helping to do when we're looking at a chart overlay in here. It can go, okay, there's all this narrative, there's a headline one way, there's a headline another way. What actually are we doing in price terms? Have we actually done something significant one way or the other in price terms? And that can be backed up by how does the volume look, how does an options picture look, and these type of things as well. But it really helps to cut through that clarity. Going back, beginning of this year, the European equity story, in technical terms, they broke out of what have been sideways ranges, as did the UK for the previous few months. So there was a very clear technical narrative for Europe, regardless of the headlines that were going on, that emerged at the beginning of the year. So I think it's hugely important. And obviously I have a bias, that's been my sort of role, but to have an overlay in there of a technical combined with that macro view to cut through that noise sometimes.
Great to see you.
And you.
Thank you very much for coming to see us. David Stanton, CEO and Chief Strategist, joining us from Snow Hill Consulting. Coming up, we're going to turn our attention to what is happening north of the border. Mark Carney wins the race to become Canada's next Prime Minister, taking over amid the country's escalating trade spat with the United States. We will focus on that next. This is Bloomberg.
My government will put into action our plan to build a stronger economy, to create new trading relationships with reliable trading partners, and to secure our borders. The Canadian government has rightly retaliated and is rightly retaliating with our own tariffs that will have maximum impact in the United States and minimum impact here in Canada. And my government will keep our tariffs on until the Americans show us respect. America is not Canada. And Canada never, ever will be part of America in any way, shape, or form.
Mark Carney speaking there, the incoming Prime Minister of Canada and the former Bank of Canada and Bank of England governor as well, now won the race to succeed Justin Trudeau. The transfer of power expected to take place within just days. Let's bring in our Canadian expert, if we can. Bloomberg's Mark Perrier joins us around the table. So what do the next few weeks, let's put months, look like for Mark Carney?
Well, it's all about, once he's sworn in this week, it's all about the general election. Question is, will he call it this week, or will he wait for the next month or two? It's got to take place before October. The momentum is there, absolutely, behind him. And Canadians are definitely up for the challenge and the fight. I think he's going to tap into that.
What are the dangers of going later? Presumably there is the sort of concern that obviously he ends up with a government that actually can't deliver, can't do what he needs to do in terms of the fight against Trump. He's obviously trying to secure, obviously, a mandate that goes longer than that. If he goes early, is there a danger that we end up with some sort of a caretaker government that can't fight Trump as well? What are the risks of kind of both options here?
I think the risks are the waiter you long, the more the narrative changes.
Yep.
As we see, the narrative on tariffs changes practically every day. So what will the situation be in a week from now, a month from now? It could be completely different. Also, it gives the Conservatives, the opposition, more time to get themselves prepared for an election.
Yeah, and so many lessons to learn from the UK in that story as well. I also just want to ask, so if that's the kind of international picture facing Mark Carney, what about the domestic picture? We know that he has a lot of experience when it comes to the monetary side of things, Bank of Canada, Bank of England, but what about the fiscal? Doubts creeping in about his fiscal plans already?
He definitely is coming into this not as a politician. He's coming in as someone who knows the markets inside out. He'll need to prove to himself as a politician as well, having how to sell these ideas to the greater public. That will be his ultimate challenge, is getting all Canadians on board with his message.
Walk us through, then, this kind of idea of if we do have everyone getting on this message, there is a very scary threat of the United States when it comes to the tariff picture, and we've kind of discussed that a little bit. There's also a question of Canada's relationship with China, for example. China putting up on agricultural tariffs today, not just on the United States, on Canadian exports as well. What kind of levers does Canada have?
The levers are very much, in the hands of the diplomats and the negotiators at doing this. Canada and China have had rather strained relations over the last few years, so they need to really focus on improving those. These are complicated times where Canada is essentially having to deal with tariff threats, tariff negotiations, political tensions on various fronts.
In terms of kind of how this now progresses, is Canadian politics effectively in the pockets of the United States, though? Because Trump can change the narrative really quickly, and I'm wondering kind of how difficult it is going to be for either of these parties, what happens to the Liberals, what happens to the Conservatives, to manage this situation with such an unpredictable Trump in the White House. Is Canadian politics predictable at this moment? How unpredictable could it get over the next few weeks and months?
It's incredibly unpredictable, I have to say. I would think Canadians would like to think the narrative still belongs to them. But traditionally, Canada, whatever happens in the U.S., always has a major impact on Canada. It's such a huge economy. They are our neighbors. And last night, Carney quoted hockey, which is the greatest thing in Canada, saying, we're not going to lose in trade, and we're not, just like we don't lose in hockey. Strong words for a Canadian.
But you've got to skate to where the puck is going to be, and we don't know where the puck is going to be, and that's the challenge right now.
We don't know. We really don't know. But I think I think they are going to come into this really, really prepared.
Did you see him on the Daily Show, Mark Carney? It was pretty funny. He was talking about how they can be friends, but he's going to need some benefits as well.
Can you do that? But as an unreliable boyfriend, is that something that
I knew
you can
would bring
expect?
that back up. Mark Perrier, we thank you as we look ahead to maybe whether that election could be called in the near term or a bit longer as we digest the Canadian politics. But here's what else we're looking out for this week. It's going to be a busy one. On Monday today, we've got the EU finance ministers meeting in Brussels. Tomorrow, we have US job openings data and important earnings out of Germany, Volkswagen, feeding in that tariff story. Then Wednesday, US CPI data and Rheinmetall earnings. Of course, the defence picture crucial at the moment. Thursday, US PPI. Friday, the University of Michigan consumer sentiment data, and also BMW earnings to cap it off. So plenty on the themes of Chinese demand, tariffs as well, and generally the health of this global economy.
OK, let's talk about the market. Let's figure out what is going to be happening in reaction to all of this. Morgan Stanley's Michael Wilson says US stocks are at risk of slumping another 5% on worries regarding the hit to corporate earnings from tariffs, the uncertainty, basically. We need to figure out where we're going to go this week and what will be the key moments. Valerie Teitel joining us now. The story over the weekend is, are we heading for a recession in the United States? And in some ways, actually, politically, you could argue that maybe Trump would want that early on. Get a recession done, move on from it, get the recovery in time for the next kind of election as it comes through, maybe even for the midterms. But in terms of kind of where we are right now, what is the data telling us, and what is the market reacting to within that data?
Well, look, I think the market this morning is clearly telling us that these recession risks aren't overblown. We have the S&P futures down over 1%, increasingly looking risk off in the market, even a decent rally into the Treasury market. The idea that you just said about Trump wanting to front load this economic pain, right? He's not even looking at the stock market. He's not even worried about the growth numbers. He just wants this adjustment to the U.S. economy to happen pretty swiftly, right? The detox that Scott Bessent was talking about on Friday. And look, this could cause a headache for the Fed, because if this data starts to show up in the job numbers, that would be something that they could react to when it comes to the May meeting. We know they're going to be on pause in the next 2 weeks at their meeting at the end of March, but the beginning of May, if they leave that door open, they could react quite quickly to any softening in the labor market. But if you look at the market this morning, I mean, it is telling us that it is taking heed to these growth warnings and from these words out from the Trump administration that economic pain is on the cards.
Does economic pain almost offset any potential yield rise from deficit concerns?
Oh, well, look, those are two things that are push and pull, right? If he does lower the deficit, there's less Treasury issuance, there's less rise in yields. But if he lowers the deficit because he's cutting spending, that's also punitive in the short term for the U.S. economy. I think that's what people are trying to grapple with right now. I mean, even Morgan Stanley's Mike Wilson warning about a 5% growth risk. They still maintain their 13% rise for the target for the end of the year. So near-term pain, but still leading into long-term growth. Will the market considerably buy that picture moving forward?
Certainly something we're going to be keeping a very close eye on. Bloomberg's Valerie Teitel walking us through some of these market dynamics. As she was speaking, continuing to see futures hit a session low. U.S. futures now down about 1.2%, and yields kind of moving in line as well. I'm looking at 424 on the 10-year across the pond. That does it for the opening trade. The brief is up next with Danny Berger and Manus Kriti. They're going to walk you through all these pre-market moves. Already seeing a sell-off in Europe, certainly setting us up for a sell-off perhaps in the States as well. This is Bloomberg.